Did you know there's a battle happening in your wallet right now? It's bonds versus savings accounts, and you could be missing out on some serious cash. In this video, we're diving into the world of these two popular investment options to help you figure out which one could work best for your financial future. Let's kick things off with some quick definitions. Bonds are like loans you give to governments or corporations, and in return, they promise to pay you interest over time. Think of it like being the bank. You're the one collecting interest. On the other hand, savings accounts are the safe havens offered by banks where you stash your cash and earn a little interest, often much less than bonds, but with much lower risk. Now let's talk about the numbers. The average savings account might offer you around 0.05% to 0.5% interest per year. Yikes, right? Meanwhile, with bonds, you could be looking at anywhere from 1% to 4% or even more, depending on the bond type and market conditions. Imagine you put $1,000 in a savings account. At a 0.5% interest rate, you'd only earn $5 in a year. But with a bond yielding 3%, you'd make $30. That's a big difference. But let's not forget about risk. Savings accounts are about as safe as it gets. Your money is FDIC insured up to $250,000. It's like wrapping your cash in bubble wrap. On the flip side, bonds do carry some risk. If interest rates go up, the value of existing bonds can drop. Picture this, you've got a bond that pays 3%, but new bonds are out there paying 5%. Suddenly, your bond isn't looking so attractive, and its price may plummet if you try to sell it. Now, how do you decide which is better for you? Start by considering your financial goals. Are you saving for a short-term goal, like a vacation or a new car? A savings account might be your best bet, giving you easy access to your money. But if you're looking to grow your wealth over the long term, like saving for retirement, bonds might give you a better return. Let's dive deeper with an example. Imagine you're 30 years old and you want to save for retirement. If you put $10,000 into a savings account earning 0.5%, in 30 years, you'll have about $16,000. But if you invested that same $10,000 in a bond yielding 3%, you'd have around $24,000. That's a huge difference for just a little more risk. So, how do you evaluate your risk tolerance? If the idea of losing money keeps you up at night, a savings account may be the way to go. But if you can handle some ups and downs for potentially higher returns, consider bonds. Remember to think about your time horizon too. If you'll need access to your money within a year, a savings account is your safest choice. But if you're in it for the long haul, say 5 years or more, bonds could be worth the consideration. Now, let's recap our key takeaways. Savings accounts are ultra safe and provide easy access, perfect for short-term needs. Bonds offer higher potential returns but come with more risk and less liquidity. Align your choice with your financial goals, risk tolerance, and how long you plan to invest. And here's where I want to hear from you. Are you team bonds or team savings account? Drop a comment below and let us know which option you prefer and why. Next time, we're diving into an exciting investment opportunity that could change the way you think about real estate, REITs. Trust me, you won't want to miss it.